welcome. My name is Scott Sturgeon. I work in the practice management group at Mariner Wealth Advisors. On behalf of Mariner Wealth Advisors and our offices across the country, we want to welcome you all and thank you for taking the time to join us. You could have been anywhere on Monday afternoon following a Super Bowl, but you chose to join us and get a tax update, and we couldn't be more excited to have you join in on that. A couple of housekeeping items before we kind of dive in. On your screen somewhere, there should be a question box and also a chat box. As we go through the presentation and kind of the discussion, if you have comments or questions or thoughts or what have you, specifically tax related, not necessarily your take on the Super Bowl game, by all means, we would really encourage you to post those, and we will probably get to them towards the end of the presentation. But having that feedback is great, and certainly we're kind of interested in kind of what your thoughts are, kind of the individual issues you're dealing with. If we don't have an answer, on the spot, totally understandable. We're happy to follow up with you as needed afterwards. And if you'd like to message one of us individually within that chat box, you're welcome to do that as well. So today's webinar, essentially tax update, relatively vanilla topic on the surface, but as we're going to find out, there's quite a bit to unpack here. To help me do that, I have two outstanding guests. I think they're going to do a fantastic job. First is Jodi Robinson. Jodi is the Managing Director of the National Tax Practice at Mariner Wealth Advisors. Jodi, thank you for coming on.
Absolutely. I have been part of Mariner for the last year and a half leading the tax practice, and we are continuing to grow and expand our reach across Mariner, and it's been a great journey. Looking forward to continuing on.
Very cool. Thank you. And our next guest is Chris Bixby, Senior Wealth Advisor in the Seattle, Washington area. Chris, thank you for joining us today.
Absolutely. Thank you, Scott. It's good to be here. As Scott said, I am a Senior Wealth Advisor in our Seattle, Washington office. Been in the industry for over 20 years. I'm a certified financial planner. And more relevant to this conversation, I'm also an enrolled agent with the IRS, and spent a lot of time focusing on that intersection of financial planning and where the tax laws come in and the tax strategies that impact the financial planning.
Outstanding. As we are going to discuss, there are plenty of those intersections to be discussed and had. So thank you. Thank you again for joining. So today's call, we have a tentative agenda, but I think we're going to keep it pretty conversational. More or less what we're kind of going to start with is kind of a year in review, rewind the clock a little bit, kind of look back over the last 12 months or so to kind of see where we've been. Obviously, if you weren't aware, there's been some major changes in our kind of national health, and obviously there have been some very specific tax ramifications because of that. So we're going to dive into that, some things you might not even be aware of that might be helpful for you moving forward. After that, we're going to kind of transition, look into the crystal ball a little bit, and kind of weigh in on what maybe some of these potential tax proposals that are coming down from the Biden administration might entail. And really from that, maybe even regardless of that, what those end up being, what are some things we can be cognizant of, or some strategies we can work to implement here in the present day to potentially find us some efficiencies moving forward. So again, a lot of it's speculative, but sometimes it's fun to speculate a little bit. So we're going to kind of dive into that. I think it's going to be really fun. So to start us off, rewinding the clock, Jodi, do you want to kind of give us that year in review?
Absolutely. So a lot of the changes that happened over the last 12 months are really starting to impact people now as they're starting to file their tax returns. So that's why we wanted to talk about some of these points, because it's very applicable to tax documents that people are gathering right now. And those are all going to should be high on radar. So I guess first and foremost, tax deadline is back to April 15th this year. Last year we enjoyed a little bit of an extension to July 15th, but we are back on track for April 15th tax deadline. So that's very important. And then the economic stimulus payments, there were 2 rounds in 2020 that went out to qualifying individuals. Those amounts were calculated based upon 2018 or 2019 tax returns, based upon what was on record with the IRS at the time the calculations were made. Those stimulus payments are not taxable, but you will need to know the amounts that you received if you did receive anything. You're going to need to know that as you work on your 2020 tax return, because if those amounts were for some reason less than what you actually qualified for based upon how your 2020 tax return shakes out, you could be eligible for an additional recovery rebate credit on your tax return as a result. So you could be entitled to even more money back as part of the stimulus payment program. The important thing to note is that if by chance you received more than what you should have, you don't have to repay that. I think that's one thing that we need to clarify. It's not a matter of you owe money back to the IRS if they gave you more based upon 2018 or 2019. So just a couple of important things there on stimulus payments. Unemployment compensation, a number of taxpayers received unemployment in 2020 for obvious reasons based upon what was going on in the country. All of that is subject to tax at federal and state levels, including if you qualified for the additional federal funding portion of that, that is also taxable. You'll receive a 1099-G from the state that you filed your unemployment in, and you'll report that on your tax return. You may have had withholdings done on that, but that withhold, when you calculate your tax return, it'll determine whether you've had enough in withholding or not. My guess is a lot of people probably didn't even have withholding on it. So don't be surprised if your unemployment benefits could potentially cause a tax situation for you. A couple other things that happened, payroll tax holiday. If your employer opted in, they could defer withholding of Social Security on eligible employees. You had to be under a certain amount of pay to be eligible for that. If you met that criteria, you were able to defer withholding of Social Security tax on your wages from September 1st to December 31st of last year. Now, those were set to be recouped. That was just a deferment, not a freebie, not a true payroll tax free holiday. It was a deferment holiday. Those were set to be recouped from employees here in this first quarter of 2021, but the December Tax Act actually extended that period of time for employers to recoup it from the employees until December 31st of this year. So it's not going to be quite a big a hit on employees to repay that. They'll have the full 12 months of 2021 to do so. And the employer will take care of all of that. That's not something that the employee has a responsibility to do. That's on the employer to take care of that. And then there were a couple of changes with IRAs last year, one being RMDs. The CARES Act allowed taxpayers to skip their 2020 RMD requirements last year. For those that did take a distribution, whether that was before the CARES Act was put in place or they took the distribution after, not really knowing that they weren't supposed to take it or could opt not to, they're still going to receive a 1099-R reflecting that they took a distribution, even if they later put it back. So that's one important thing to make sure of, is that you're collecting all your tax documents and that you're also collecting documentation for your tax preparer that shows that you actually rolled that back into your IRA by the August 31st deadline that the IRS put into place. So just make sure that you've got all your documents in place for that. Even if you get a 1099-R that shows that you took a distribution, that doesn't mean that it's going to be taxable. If you met all the requirements and put it back in place by the timeline they put in place, you're going to be okay. Just keep the documentation. And then also IRA distributions could have been taken penalty-free up to $100,000 for taxpayers who were impacted by COVID. And I say impacted by COVID because the IRS put into place some requirements that you are supposed to meet in order to be able to take it penalty-free. And that means you either tested positive for COVID, you cared for an immediate family member with COVID, Maybe you lost your job or your business was impacted because of the quarantine or because of COVID. If you meet those I was impacted by COVID requirements, then that $100,000 that you took as a distribution could be taxed over a period of 3 years if you decide to keep it. You could also repay the full amount back and not pay tax on it at all. But I guess I bring this up because you need to be talking to your tax advisor about how you want to recognize that distribution that you took, whether it's one year, 2 year, or 3 years, however you want to do that. Based upon the latter half of our conversation on this webinar, there may be some planning to do around that if tax rates are expected to change. So, and then lastly, I want to touch on this real high level because we could spend hours-long webinar talking about this in itself. But if you're a sole proprietor or small business owner that received PPP funds, Paycheck Protection Program funds, there was a lot of confusion this last year over how those were going to be treated. The IRS clarified at the end of the year that this PPP income that you received is not going to be taxable to you. And they also clarified that the expenses are going to be fully deductible. So again, staying pretty high level on that, the PPP proceeds were clarified. And then also if you received an EIDL, an economic injury disaster loan, you could apply for one of those of up to $10,000. That is also not taxable. Expenses are deductible. So good news from the IRS on that. And those, and there were a ton of other things that we could have included in this part. We really went through and selected the ones that we thought would probably be of most interest and applicable to a broad cross of people.
Thank you, Jodi. And they're all excellent points. And a lot of them are kind of, there's not a ton of precedent for this. I think kind of given where things were this time last year, there were just so many unknowns that all of these tax code changes came down very, very rapidly. And people were kind of at the time on the fly having to try to figure out what's the long-term ramification of this. But, you know, if you need to withdraw from a retirement account to fund whatever the situation is, and it's an immediate need, sometimes tax ramifications just don't come up as unfortunately it's kind of an afterthought by necessity.
Right.
So thank you so much. I guess one point a theme I've seen overall is communication with your tax preparer is key for all of these. If you took advantage of any of these, we'll call them strategies or situations, that letting your tax preparer know that you actually did seems to be crucial. Have you seen a lot of communication from whether it's clients or individuals you've worked with on that?
Yeah, as tax documents are starting to go out to clients and other taxpayers, certainly starting to get information in for tax filings. I think the most important point on that this year is, historically, I think people have gotten into the habit of just sending their tax documents to their tax advisor. This is not the year to just send them off, because when it comes to IRA distributions and some of these other things, there's going to have to be a conversation had around, okay, the 1099-R shows that you took a distribution. Let's talk about what you did with it and whether this is actually taxable. So this isn't the year to just scan an email or put them in an envelope and send them off to your advisor. This is the year to have a conversation about it.
To be sure. I mean, many of these instances potentially have years of tax ramifications with them. If you took, for example, a distribution from your IRA and you're paying that back, I can't remember what I had for breakfast. So how am I going to remember a year or 2 years down the line of what amounts were and what they were utilized for and things like that? So your point is perfect, in keeping diligent records of that.
Yes.
Well, Jodi, thank you again so much. And like you said, there were a ton of different topics we kind of considered for this, and we had to kind of distill it down, obviously, for a 45-minute presentation. But thank you for delving into each of those. So, we're kind of we're in the present day here, and some of those proposals and issues you just described, we know a lot more now than we did even maybe 6 months ago of what the ramifications is going to be of using them. But now there's like this whole other discussion around what is going to happen with a new administration coming into the White House. There's all this discussion around, Joe Biden on, at a presser in Iowa said this, so it's going to occur. We just don't really know in some instances, but they've kind of laid out some plans tentatively. And so if it's okay, I would be great if kind of you and Chris kind of maybe talk through some of what those are. And again, like we described, if there's things that we could be doing or thinking of moving forward to get in front of those, or at least to be mindful of them, that would be great.
Yeah, absolutely. And we've had a lot of tax planning conversations surrounding a lot of these points already with clients. Certainly, we don't have a crystal ball, but the things that we're going to talk about were things that were repeatedly mentioned as part of tax proposals. And then, we're also not certain of when these might take impact or take effect. Likely in 2022, where tax world is thinking probably not sooner, just because there's going to be some economic recovery that's going to be the focus of this year. But there are certainly things that we need to be doing with our clients, and other people need to be doing with their advisors that we're going to talk about today. So first, one of the things that we wanted to touch on was the additional payroll taxes being proposed on high earners. This is Social Security payroll tax normally cuts off at around 140, right? This year it's 142,800. That's adjusted for inflation every year, and that's the normal cutoff. One of Biden's proposals is that it cuts off at that, and then you have what they've been referring to as a donut hole, where you have zero payroll or Social Security tax withheld above that level, and then it would kick in again at above $400,000. So that's one of the things that they're proposing, and I know Chris has some thoughts on how we may be able to help advise and plan around that.
Yeah, and thank you, Jodi. I mean, this is one of these areas that is a seismic shift, right? It's something that economic wonks have been talking about for decades, is how do we solve, right, this looming problem we have with Social Security. And one of them has been raise the income wage limit on Social Security so that we are collecting higher benefits, higher amounts from people who make significantly more income. So this is not new, except that it's now actually into some tax proposals, right, that someone wants to try to take some action on. Historically, it's been a non-starter, so I'm not sure how much legitimacy there is, right? But we do have to be aware that this is coming, that there's more momentum behind this than has ever been before. And so what are the things that we should start to think about in the event that this does happen? Now, obviously, when we're talking about $400,000 in wages, we're talking about a smaller segment of the population. We're talking about people who are highly compensated. Typically, these people have more control, have more negotiating power in their contracts. And so I think that's what we need to think about, is that people over $400,000, if you're looking at setting up wages, or you have wages that are over $400,000, now's the time to jump into your benefits package and really understand what are the types of benefits that I have. If you have a non-qualified deferred compensation plan, depending on how it's set up and where you are in relation to when you get the benefits from that, you may be able to defer some payroll taxes until maybe when you're retired, right? Or very soon after you finish work, or when you're making lower income because you've slowed down at your job and aren't working as much. And so we need to consider that. If you have stock options, non-qualified stock options are something that could be beneficial in accepting part of your pay rather than an actual payroll in a W-2, maybe actually get stock options instead. Now, when I say stock options, by the way, if you have incentive stock options as part of your existing plan and you make over $400,000 a year, you need to get with an advisor as soon as possible because incentive stock options have some very funny tax characteristics, and they could cause major problems for people with income above the $400,000 level of income. So if you have incentive stock options, it's now the time to set up a plan for what you're going to do with those options. So again, people with higher income need to be looking at their benefits plan. And let me talk about one aspect specifically. We talk about fringe benefits, and no one really understands what fringe benefits are. They might be tuition reimbursement, child tax, adoption credit, things like that. But let me specifically mention health savings accounts. Okay, health savings accounts are a fantastic way of deferring income, if used appropriately, making that income tax-free, not just from income tax, but also from payroll taxes. And when we think about an aging population, people who know we are going to have expenses in the future for medical care needs, then a health savings account is the most tax-advantaged way of setting aside money today for known expenses in the future. And for someone who's earning over $400,000, if we have this donut hole situation happen with higher Social Security taxes on higher earning individuals, an HSA is something that we should be funding to the maximum if that were to happen.
Great points, Chris. And I love the HSA idea. I'm a huge proponent of it. My wife and I sometimes have go-around arguments that I insist on keeping funds in the account versus paying for things in the present day. But thankfully, we've come to some sort of agreement where it actually does make sense. So perfect points all around. Thank you so much. Jodi, I know that there's some income tax rate changes coming down the pipe potentially. Do you want to kind of touch on those?
Yeah, and again, really targeting taxpayers in the what they're terming high income earners at $400,000 and above is what has been thrown out. So relatively unchanged tax brackets below $400,000, but at the $400,000 mark, likely 39.6% tax rate is going to be coming back into play. So again, a lot of planning opportunities around this, and some of them probably backwards into the way we are normally thinking about doing tax planning. Right, Chris?
Mm-hmm. Yeah, absolutely. And by the way, this is one, unlike the Social Security conversation where we said this may or may not happen, this one is something that is going to happen, right? The Trump era tax laws that lowered the highest marginal tax bracket were slated to expire in 2026. The Biden proposals do two things. One, it speeds it up till whenever they pass that law, right? That's number one. And two, there is a 35% tax bracket that it gets rid of, okay? So people in that used to be 35%, are going to pay a little bit more in taxes for sure. But the high income individuals over 600,000 or so in wages, they would get taxed whether it's next year if this tax law passes or in 2026, they're going to have those same tax rules because again, the Trump tax bills were basically reverting, were a short time period, reverting back to kind of what has historically been the top marginal tax bracket. And I say that because that just brings into focus from a planning perspective that we have to plan for higher taxes. And so as we're looking at planning for higher taxes, we kind of go against the grain a little bit. As a general rule, when you're planning for taxes in general, you say, let's go ahead and defer income as long as we can. And let's go ahead and speed up deductions as soon as we can. The faster we take deductions and the later we take income, then we're just going to defer those taxes. But deferring taxes is a problem if you're deferring taxes to when you'll pay more in taxes. And so that's what we wanted to think about now is really accelerating income. What are the things that I can do to take income now? And expenses. Are there ways of deferring income, right? Business owners, for example, they buy a piece of equipment and they immediately want to take that Section 179 deduction, right? Take all the expenses in the first year. we may need to start to think about actually taking that normal depreciation schedule and taking that expense over 5 years, 10 years, depending on the life of that product, okay, of that service. So again, deferring expenses. We also may want to look at things like Roth conversion. For people who are entering a lower income period of their life or in retirement before the age of 72 when the required minimum distributions start, and even for some of them at age 72 or 73 when those deferrals, then those required minimum distributions have kicked off, if we take income sooner at a lower tax bracket that prevents them from having higher income later, then that's going to be a good thing. And so planning with a tax advisor, not over take all my IRA and convert it all immediately into a Roth IRA, but taking portions of your IRA every single year to max up and fill up a tax bucket up to a maximum level, that can add significant value when you're thinking I could be paying 4, 10, 15, 20% less in taxes by having that income today rather than having it in the future. And there's one other aspect that I'd like to talk about, and that's just timing deduction. Okay, because as part of this higher marginal tax bracket, there's also coming some limitations on how much in itemized deductions you can take and the value of those tax deductions. And so again, typically we've said just take all the deductions as soon as you can. Now we want to think about what is the timing? How much in deductions do I want to do? Do I want to double and triple up? Maybe pay my property taxes all up at the beginning of the year, or maybe defer if I'm allowed to. What about charitable contributions? Using donor-advised funds. So rather than making a single gift to charity, maybe fund a donor-advised fund into 2, 3, or 5 years to charity that I would do anyway, have it deducted now or at some point in a specific year could make a whole lot of sense. And by the way, with donor-advised funds and charity, depending on your situation, it might be a sense of bringing your deductions forward because you may lose them in the future depending on your income tax bracket. So it goes both ways. For some people, it's defer. For some people, it's take it early. And that's why we say the timing of deductions is going to be incredibly important in the next 5 years for sure, and maybe even just in the next year or two, depending on if the Biden tax proposals were to be passed into law.
You're exactly right, Chris. Those are all outstanding points. That timing piece you refer to is so custom to each individual tax picture too. I think that's a huge point that can't be understated. So thank you for illuminating all of that. The next point we wanted to touch on, this one would be a pretty seismic shift, in terms of the way that gains on investments for very high income earners is essentially viewed and taxed. Jodi, do you want to kind of explain what that proposal looks like?
Yeah, so the proposed change would be that what we currently enjoy as a preferential tax rate on long-term capital gains, which is held for a year or longer, and qualified dividends would increase from current 15 or 20%, depending upon what tax bracket people are in, to the ordinary income tax rate. And what we read in the proposals is that this would be applicable on income over $1 million. Now, we're still waiting to figure out what does that exactly mean. Is that gains over $1 million? Is it total income over $1 million? We don't really know what that looks like. The important thing to know is, though, that if you're in the 39% tax bracket, you just lost a whole lot of tax savings that you would have had on long-term capital gains. So very important to be thinking about that. And then one other note as it relates to capital gains is that also in the proposals is the possibility that like-kind exchanges on real estate could be eliminated, which is huge for people in the real estate industry. So I think Chris has some thoughts on what we can do to be planning, thinking ahead in advance for these things too.
Yeah, and Jodi, you used the right term, seismic, right? This is big. And this is important because it's going to affect a lot of people. I mean, just think if long-term capital gains rates are 20%, and now all of a sudden they go to being taxed at your ordinary income tax rate of 39.6%. I mean, we're talking they almost doubled overnight. So this is big. And again, it's one of those things that, we don't have a whole lot of control over. We don't know if it's actually going to pass. And so we need to think about it just from a couple different perspectives, just to make sure that you understand the impact to your portfolio specifically. And as a general rule, when we talk about stocks and portfolios and taxes, we have a concept called tax loss harvesting. And tax loss harvesting basically says if you have a loss in your taxable portfolio at the end of the year, go ahead and sell it, right? Keep that loss, generate that loss to offset other gains in your portfolio, or bank it to offset gains in the next year in your portfolio. And that basically defers taxes, right? We talked about it on the income side. Take all the deductions up front, right? Defer the income as long as possible. Tax loss harvesting does that. In this situation, we have to think about it differently, and we have to think, wait, if I'm in a taxable bracket or have such large gains in my portfolio that I could easily be breaching that $1 million level, then I need to think about taking the gains earlier, right? I need to harvest gains instead of harvest losses. And in fact, I may want to defer the losses, right? Not take the losses yet and wait until these tax law proposals are either in law or out of the radar, so they're not going to be an issue anymore, before claiming certain losses where I have control over when I can claim those losses. Okay. And so again, harvesting of gains is very important. Jodi mentioned the 1031 like-kind exchange rules. This is for people who own typically real estate. They sell a piece of real estate and invest it through a process called a qualified intermediary, but basically the money doesn't come to them, it goes to another party, and then they purchase another piece of real estate, and current tax law says you don't have to pay the tax in that transaction. If that goes away, one, there's a lot of people who've been rolling through like-kind exchanges for decades, and they have virtually no basis. It's all gain in their portfolios. And so that could affect very highly their strategies. And so if you have like-kind exchanges, when you have real estate, we need to think about, as you have a liquidity event, which is not always in your control, but if it is, maybe speed up the liquidity event to go ahead and pay the taxes now at a lower tax bracket. And by the way, we do know that there's going to be some changes in 2026 to capital gains rules anyway. So there is some incentive at certain levels of taxation for people to go ahead in the next 5 years and start to take some of those gains off the table. One other aspect to this capital gains story, and it kind of talks about estate planning, which I think we're going to jump into here after this for a little bit, and that is that in this capital gains world, they're also talking about stopping the step up in basis rule. Now, what that means is that if I purchase the stock at $50 a share, that's my basis. Over the years, I've held this stock, it's appreciated in value, and now it's up to $250 a share. If I sell it, I pay that difference from $50 to $250. However, if I pass away and leave it to my heirs have what's called a step up in basis. It means that $50 kind of goes away. It jumps up to $250, the current value at the time of death, okay? And that's where my heirs sell it from. They sell it from a basis of $250. If the stock price is now $275, they only pay tax on the $25. I think we know many, many situations where people have, over the years, created wealth that is appreciated in value, and their strategy is do nothing. Don't touch it, right? I'm going to leave this alone. When I pass away, my heirs will get that step up in basis, and that step up in basis means they will pay much, much less tax, no tax on the gain, versus if I sold it. And so this can majorly change the strategies that some people have regarding capital gains in their portfolios when it comes to their estate planning. So if this happens, right, now we're going to really start a serious conversation, one, about accelerating the capital gains, but two, we're also going to be talking about the use of highly appreciated stock for your gifting to charity, right? Rather than you selling it and giving cash to charity or using money out of your checking account, now gift them stock directly, let them sell it, and because they're a charity, they won't pay any capital gain. Any capital gains on that. So gifting to charity via stock is going to become even more important for certain people if these tax laws change. And the other aspect is actually gifting to your heirs, giving them stock if they're in a lower tax bracket, right? You sell the stock and you pay 40% in tax essentially, but your children or your grandchildren are sitting there in a much lower tax bracket. Maybe gifting them appreciated stock and letting them pay the taxes is also a strategy that we would want to consider. So a lot of changes when it comes to how we're managing gains inside of our portfolio, and these tax laws could be very, very consequential.
Great points, Chris, and it really is enough to make your head spin. If you have an investment account, you're doing this in one area, you have a rental property that you're looking to sell, you know, the IRS looks at it all the same. They're all gains and they all go together. And so for you to kind of tally that up, you know, on the back of a napkin on your own may not lead to the best or most tax efficient strategy or implementation that's possible. So great point.
And I will jump in. We're talking about capital gains taxes. The truth is that if you're dealing with real estate, there's other types of taxes called recaptured gains taxes. There's the net investment income tax for certain levels of income. There's multiple avenues of taxes that we're just talking about capital gains, but there's multiple other areas of taxation that fit into this conversation.
There's no question. And Chris, you alluded to it earlier. This is the kind of the last topic we'll touch on, but the changes to not only the step up in basis for assets passing at death, but also the potential lowering or reduction to maybe pre-2017 numbers for the estate and gift tax exemption could make huge changes in the way that estate planning is gone about for if the change occurs, likely thousands of more individuals who, you know, in the last couple of years have enjoyed literally some of the highest exemption amounts in history for their estate. So Jodi, do you want to kind of touch on that and give kind of an overview of what's kind of at stake?
Absolutely. So as you said, over the last few years, we've had the luxury of very high or the highest that we have seen estate and gift tax exemptions. Today, in 2021, those are $11.7 million per individual. So that means that a lot of estates have gone unfazed by estate tax situation, and then also allowed a very large window for people to do gifts, because the estate and gift tax exemptions are both at that $11.7 million rate. So we're actually dealing with a couple of looming deadlines here, which means that people need to start thinking about this very, very soon. Because even if nothing changes with Biden's proposal, we are still looking at a 2025, a tax year 2025 sunset of these $11.7 million provisions that we have. That sunset would mean that the exemptions would roll back to $5 million each. So a pretty steep haircut, even if nothing changes with Biden's proposal. If Biden does change, Biden's plan does make it change, it would roll it back to $3.5 million. And as Chris said, could eliminate the step up to fair market value. All of these things in play, regardless of whether Biden's changes don't take effect and the sunset does, we're still dealing with significant haircuts to the $11.7 million. If it rolls back to 5 or 3.5, people need to start thinking about what they need to put in place now. And I think Chris has some thoughts on some of those planning opportunities, what people need to be doing.
Yeah, this is definitely an area where long-term planning is essential, right? Just leaving it up to, oh, we'll see what happens, just doesn't work from an estate planning perspective. So, one of the things that we want to do is to, one, do a needs-based analysis. A few years ago, well, probably 12 years ago, 15 years ago, in George W. Bush presidency, we saw some significant changes. In fact, one year there was no estate tax at all. And so it kept on jumping back and forth and reverting, and no one knew. And there was actually a situation, an attorney went to his clients and said, listen, this $10 million exemption is never, ever going to come back. So you need to give away all your money now as fast as possible just to take advantage of it. And one of his clients, who later became one of my clients, came to me and we started doing some needs assessment and realized that she had given away way too much money, right? And she'd given money irrevocably to her heirs, and she wasn't getting any more, and she was going to be relatively penniless at a very young age, in her early 60s, okay? Obviously, a lawsuit was started, and the attorney settled because they had committed malpractice for the benefit of for what their clients needed. And so I say that just to say we have to, one, understand whether or not you are in a situation where you have resources that you will never need in your lifetime. And so that's a financial planning needs analysis to really lock in what assets and what resources do you have. That's number one. Number two, we're only looking at this it's kind of an all or nothing thing, right? If you have an estate worth $20 million today, we'll just say, right? And between you and a spouse, that means it's less than the $23 million level. You don't have an estate tax problem. But if the numbers start to drop and go to $5 million each or $3.5 million each, then all of a sudden you're in this level where you have now, $10 million or more that are going to be subject to estate tax. Okay. So the strategy here would be something along the lines, let's do a needs analysis of that $20 million. How much do you need for the rest of your life? Okay. And let's just throw out a number. We'll make it easy. I like easy math. So if we'll say $5 million is the number that we're going to use with you. And so that means you have $15 million left over. Okay. You're going to spend 5 of it, but 15 is left over for your heirs. At that point, what we would say is then one of the spouses, right, needs to give away $11.7 million, right? Use up their lifetime exclusion, right? Get rid of it completely. They have no more assets, okay, as far as their estate plan goes. And that way we're taking advantage. See, what happens is if you split it up and each one does $5 million roughly, and now the limit drops to $5 million, you did nothing. You still have $15 million plus of your estate that's subject to taxation. So the only benefit is really to do the full amount if you can afford it, right? And so that's where the intersection of law, right, using a qualified estate planning attorney, but also wealth management and financial planning to really understand how much of these resources are we likely never to need. Do we have $10+ million that we can afford to give? Doing gifting now at this point is going to make a lot more sense than it ever has before. And by the way, giving it now takes advantage of the exemption, number one. Number two, it also says any appreciation on that $10 million, $15 million, whatever the number is, now happens outside of the estate and is now not part of the estate tax environment. So now it's taxed to further future generation. So again, for certain types of individuals with large estates and assets that they know they would never need, this is the time to start thinking about some very serious gifting that uses up this lifetime exemption that, frankly, will be back at some point in time, right? History has a way of repeating itself, so I can't guarantee it, but it's probably going to come back. But when it comes back, you may no longer be alive, right? So it's one of those things that we need to plan for death, right? Unfortunately, but we have to plan it in the event that something happens after these tax policies have either sunset, which is what's going to happen right now under current law, or the Biden tax proposals come into effect.
Excellent points, Chris, all around. I think it is a pressing topic, and one that, I mean, candidly, estate planning is sometimes a little difficult to converse about, whether it's with your advisor or your CPA or your estate planning attorney. You know, that's their job, and it's still difficult. But you know, there are very real tax consequences at play. Everyone on this call has an estate plan. It's an old saying I've heard. Everyone's got their estate plan. It's just a matter of whether you actually have control over it or not. So certainly Chris's points and Jodi's as well are prescient and certainly worth consideration. The one piece I would add, I think that's kind of interesting, is we sometimes hear clients talking about, well, you know, my net worth currently, that's, you know, assets minus any liabilities I have, maybe it's under current exemption amounts. But we know that maybe in 5 years or 10 years or what have you, a $4 million current net worth could very well balloon to 6 million or more, to where this actually becomes an issue. So I would caution by saying dismissing it immediately is not necessarily the best approach for long-term positive outcomes. But Chris and Jodi, excellent points all around. Thank you both so very much. And I think we that kind of brings us to the conclusion of the meat and potatoes of the discussion. But we have a ton of questions. So if it's okay with you guys, I'll cycle through a few of these. If I miss anyone on these, I apologize. We have a lot. I'll just kind of go in reverse order. Considering the 1031 exchange going away, if you are currently in a 1031 and a venture is sold, will you be able to roll the proceeds into another 1031?
So I'll just jump into this. Again, it depends on what you rolled your 1031 into. There are certain programs that you can roll a 1031 into, but then once that ends, you can't do another 1031. So there's a whole lot of gray area here that we need to discuss. And so again, if you're currently in a 1031, every time that a transaction happens, that a sale event happens, you have a new tax transaction. You can either pay the taxes, or if eligible, you can roll it into a new 1031. So in the case that I think they're referring to, they already did one 1031. This is that looming tax bomb that I said could be hugely consequential. And that is, now this 1031, after the Biden bill has passed, gotten saying no more 1031s, now there's a sale of that property. Taxes are now due at the sale of that property. There is no more opportunity to roll into a 1031.
And I think, Chris, you touched on this. Sometimes you have control of when these transactions happen and when they don't. I mean, certainly there's going to be a lot of people pushing for a lot of these transactions to happen in 2020. Or 2021, when we think that we can still take advantage of those rules, because I mean, I guess everyone's assuming that in 2022 that could change, 2022 or 2023 that could change. So certainly, if you have any control or any say in the matter, you want it to likely happen sooner versus later.
Great points. One more of a, great session. Is this being recorded to re-review? It is. Outstanding question. Thank you for the positive feedback. I'm not sure if Biden is getting rid of the over 55 home sale exemption. Can you elaborate? Is that something we're familiar with?
Well, there is no home sale exemption, so to speak. The old rules went away of when you could like roll your gain year after year. Now it's an exclusion amount that you get. A married filing joint couple gets a $500,000 gain exclusion on the sale of a primary residence. a single filer gets $250,000 gain exclusion. So some of those older rules went away a few years back, and now we just have that set exclusion on a primary residence sale.
And that is not age dependent. So that is for anyone who has owned their home for 2 out of the last 5 years, assuming they don't have any rental periods in there that mess the calculations up. But yeah, there's no longer any age issues around a sale of a home and a deferral or exclusion of gain.
Perfect. I'm hopeful that, I think that answers it. I'm hopeful. This is an interesting question. I think this is a good one. If you are already in the highest tax bracket, and you will be for the next maybe 5 to 8 years, they're now 63, and they have a sizable 401k in the multiple millions of dollars range, let's say. How would you approach a Roth conversion for this scenario, or does it even make sense to consider it?
Yeah, and from a planning perspective, there are times certainly where there aren't those gaps in earnings years, right, where you're in a lower tax bracket. No, if you look at a Roth conversion, the analysis for a Roth conversion says it's net equal if you're going to be in the same tax bracket. There's no benefit to a Roth conversion directly, okay? The only benefit to a Roth conversion, if you're in the highest marginal tax bracket, is to your heirs, right? Because now they inherit an asset that you've already paid the taxes on. So as there's net, if you're going to be in the same tax bracket, then there's no benefit to making a Roth conversion. The only time to make a Roth conversion is if by doing the conversion, I can pay taxes at a lower rate, then at age 72 or later, I'll be required to take the money out at.
That's perfect. And there's some sort of assuming time horizon for that break-even point to where.
Correct, right? There definitely are. It depends on the assumed rate of return of the portfolio and things like that. And there is a holding period requirement after you do the Roth conversion. So there are some technical rules that typically you don't want to do a Roth conversion and be pulling the money out in the next couple of years. You need anywhere from a 5 to a 10-year time horizon for it to pay off, assuming you are, again, but a lower tax bracket is pretty much implicitly required for there to be a benefit.
Right. Let's see, unexpected changes around capital gains tax. I think we covered most of that. It's largely targeted towards high income earners. Anything to add?
Correct.
Anything we missed? I don't think we got
I don't think
that
we
one.
missed anything.
Again, question on cap gains rates going forward, about them being taxed at ordinary rates. Again, very high income earners, that's kind of where we're looking for that. Let's see. After the donut hole, is the FICA rate 6.2% plus the Medicare rate? Is that correct?
Yes. Yes.
Any HSA limits, any signed HSA limits will go up to some level that better correlates to medical costs. Huh.
This is definitely something that there is quite a bit of conversation around in the senior and aging circles and medical and healthcare. Actually, a number of years ago, I wrote my master's thesis on medical expenses in retirement, and so I studied this quite in depth at the time. The HSA limits are ridiculously low for the level of call against the expenses, especially when you consider that most people at the time that they're contributing to the HSA tend to, not in every case, but tend to have lower expenses than the HSA limit. But if we're talking about saving for the future, even maxing out the contributions and never spending, Scott, to you and your wife's conversation, right? Never spending any of the money is literally a drop in the bucket to what you would actually need. And so, yes, if Congress shifts their view, right now they're viewing HSAs as a way of funding current medical expenses. There's starting to be some momentum towards it's actually starting to fund future medical expenses. And I think once that shift happens in the thought, in Congress's thought process, that's when we'll start to see higher contribution limits. There we go. Contribution limits to HSAs.
I would add, it's interesting, HSA accounts in general have grown. The amount of people utilizing them and the amount of contributions to them has increased pretty significantly in the last 5 to 10 years. It's a great question. I think I would agree. It likely higher than not in the future,
especially for families.
Mm-hmm.
Correct.
This one, this is good. If you're a self-employed consultant and have past years of income, but during this pandemic year received zero income, can this offset some of the IRA withdrawals that we took?
Oh, absolutely. So they're saying that they, I guess, maybe had still incurred some expenses. Mm-hmm. Maybe incurred a loss, zero income or loss. I mean, that gives you additional room within your tax bracket to, absorb some of the IRA distributions that you had.
Yeah, and there's two factors here. One is if you have losses, you may have a net operating loss for your business. And that net operating loss, there's several different things that you're allowed to do, include carry it back to prior years to recoup some of your taxes paid. But certainly from a Roth conversion perspective or other income perspective, it's going to put you in a much lower tax bracket. I did personally have a couple clients in that situation, and we actually already had a target for Roth conversions and what our expected tax brackets were going to be. And when they started not hitting them, either because they worked at a company and didn't get their bonuses and their incentives, or they're self-employed and didn't see as much income, then we knew that we were going to have some room between their expected normal tax bracket and their current tax bracket, and we went ahead and did Roth conversions. So that's where it's good to have your target set for the year as far as, what are limitations. So as my clients get their tax returns filed, I'll be getting copies of all of those tax returns, and we'll be setting up a tax strategy for the year. If this happens, right, and you fall below these levels, here's the Roth conversion, or here's the capital gains that we're going to exercise. So it's good to have that plan early in the year. Last April, we actually did a bunch of our Roth conversions, right? Because the market dropped so precipitously. We knew we were already going to do those. We went ahead and did a chunk of them in April to take advantage, get more impact on our conversions. But you have to have that plan early in the year so that you're not left just struggling by December 31st. This stuff has to be done by December 31st. You can't wait until your filing deadline. It has to be done by December 31st. So have that plan.
Converting on a market drop probably requires an iron stomach too. I think that's and a great advisor. Small caveat there. This one, I apologize if I don't put this across correctly, but in reference to Medicare and Part D income penalties, were there any provisions to help or limit the income-related penalties during the COVID year, during 2020? Such as in addition to life changes needed to seek reduction. I'm not sure on that one.
I'm not exactly sure, because technically this would help you, right? In COVID year, you saw less income, unless maybe someone had higher expenses due to taking care of family members and had to do one of those $100,000 Roth distributions. But again, they can repay it over 3 years. So I don't see how COVID would do anything but typically reduce your income, which would reduce potentially the amount that you're paying on your Medicare insurance. So as a general rule, we're seeing lower levels there, not higher levels there. So again, not understanding the question fully, but I don't see that being much of an issue.
I think that makes sense. Any changes to the capital loss carryover deduction amount? Is it still limited to $3,000, or any Section 1231 changes?
Correct. Same carryover.
That's an easy one. I
like the easy one.
Yeah. This individual did not take an RMD except for a QCD, a qualified charitable deduction or distribution, excuse me, is there any impact, if any, from that?
No, that's same treatment as always on the QCD. So you can normally do up to $100,000 of your RMD as a qualified charitable distribution. Those rules did not change for 2020. So if you had that plan in place and executed it, same tax treatment, excluded from income.
And again, this is just for people who are already in their required minimum distribution phase of their life, not for people under the age of now 72.
Right.
Well, we are just about, well, first of all, fantastic answers. Thank you all for the assistance. We have a ton more questions, but we're here at the top of the hour. Again, it's the
Scott,
time has flown by. And Chris,
can
yeah,
I
know
just
you have one more point to make.
one thing? Yeah, that we just didn't get to, but I think it's important. There's a lot going on in the conversations around student loan forgiveness, and nobody knows what's going to happen right now, but many of my clients have set up 529 plans. They have the income to pay the student loans and all of those things, and filing the FAFSA forms or whatever is just not part of their reality. If the government passes a bill that says everybody gets $10,000 of their student loans forgiven, now might be the time to consider taking on some student loans and just seeing what happens. Low interest rates are fairly low right now, leaves your money working for you potentially a little bit longer. But hey, I don't know, paying $10,000 myself or having it wiped out of my kids' student loans, I think I'll take that free student loan reduction. So again, we don't know what the rules and the caveats will be, but it just might be something to consider, that student loans might make a little bit more sense than they have in the past.
Is that worth the pound of flesh and filling out the paperwork, right?
For $10,000, I think it is.
Well, certainly novel approaches and maybe strange times we are in, but regardless, Chris and Jodi, thank you both so much for taking the time this afternoon and evening to provide what I think are some really helpful insights that people should be thinking about, and that might be relevant to their individual situation. I hope we tried to get to all the questions. If not, by all means, don't hesitate to reach out to us through MarinerWealthAdvisors.com. We're always happy to have a conversation and see if if something that we can do might bring value to your personal situation. So thank you all again for tuning in, and everyone have a great evening.
Thank you.
Thank you.